All right, welcome back. So our next panel is called Financial Firm Spotlight, and it deals specifically with enforcement and regulatory developments for asset managers and broker dealers and the like. And so let me start off by introducing our moderator, Sandra Hanna, a partner and co-founder of the law firm Bruch, where she represents defendants in all types of investigations and proceedings by the SEC, the DOJ, FINRA, and various other state and federal agencies. I was interested to see in her bio, prior to attending law school and business school, she managed the professional careers of a number of Grammy award-winning musicians. Very cool. Welcome, Sandra.
Several lifetimes ago.
Yeah.
Nice to be here, Bruce. Thanks for having me.
Very pleased to welcome back Adam Aderton, the co-chief of the SEC Enforcement Division's Asset Management Unit. So he is the perfect person for this panel. As you probably know, that's a specialized unit that's charged with investigating the very financial firms that we'll be discussing today. So Adam, always great to have you, and welcome back to the Securities Enforcement Forum.
Yep, thanks for having me.
Next, let me introduce Terence Healy. He's a partner at Hughes, Hubbard. Prior to re-entering private practice, Terence was a senior assistant chief litigation counsel for the Enforcement Division, and he regularly represents financial institutions and hedge funds and private fund advisors. Really pleased you can join us today for this panel. Terence, welcome.
My pleasure.
And finally, we have Dr. Jennifer Marietta-Westberg, who is a principal at the consulting firm Cornerstone Research. Jennifer brings the unique analytical perspective of a PhD in finance, but combined with the fact that she worked for 10 years at the SEC, where she served as the deputy chief economist and the deputy director of the Division of Economic and Risk Analysis. Welcome, Jennifer.
Thanks, Bruce. Great to be here.
Great to hear from you, as always. And I welcome Sandra to take it away.
Thank you, Bruce, and thank you, audience. I hope that you ask us questions throughout this. We hope it's interactive. We have a lot to cover here today. Jennifer and her team at Cornerstone publishes a heat map of enforcement matters, which show that fully a third of enforcement matters concern financial firms. So we have a lot to talk about today. We'll do our best to cover the most active of these enforcement priorities, digital engagement matters, ESG issues, and hopefully we'll get to issues critical to private funds as well. We'll do our best to cover a lot in a short amount of time. So let's start with digital engagement practices. Over the summer, the SEC requested comment on broker-dealer and investment advisors' practices. Chairman Gensler has said numerous times that game-like features and other design elements on apps may encourage investors to trade, but could result in a parade of horribles, such as conflicts of interest for customers. 2 months later, the commission released the GameStop Report, technically the report on equity and options market structure conditions, echoing the themes in the request for comments and focusing really on restrictions related to trading, payment for order flow, dark pools, short sellers. Adam, what does it all mean for us as an enforcement community, and where should we be focused?
Thanks for the question, and I'll start with the disclaimer all SEC speakers are required to give. My remarks today only reflect my own views, don't reflect the views of the commission, any of the commissioners, or others on the staff. So I think to start with, the digital engagement practices are sort of a subset of the broad theme that we've heard a couple of times already today about rapid technological change. And in putting out some of the statements around digital engagement practices, the chair and others have noted that these practices allow platforms, including financial platforms, to tailor their marketing messages or to tailor their sort of prompts and nudges based on information about particular clients or customers, and that, as you noted, that presents some sort of newer or sort of older risks, but presents them in a new way. And in particular, I think from the enforcement perspective, the conflicts that are potentially attendant to those kinds of digital nudges or digital recommendation targeted marketing are things that are worth thinking about if you are a registrant in this space or you are an advisor to a registrant in this space. And so some of the ways that an issue could arise here, that conflict issue could arise, you could think about a brokerage firm that makes more money when its customers engage in more trading. If digital engagement practices are optimized for those revenues that are result from additional trading, as opposed to optimized for the customer's overall risk-adjusted return, potentially there is a conflict issue there. Similarly, on the advisor side, in particular with something like a Robo Advisor, you could see digital engagement practices that might favor the selection of higher cost products over less expensive products that would again result in more revenue to the advisor compared to the revenues that they would obtain by making a recommendation or by offering products that are specifically optimized for the client's interest. And so I think when you're thinking about this from an enforcement perspective, setting aside some of the concerns about bias, setting aside some of the concerns about systemic risk that come along with digital engagement practices, I think the conflicts sort of along the lines that I just laid out are probably should be top of mind.
Thanks, Adam. In GameStop, no one has been charged by the commission, as far as I know. I don't know what's in the pipeline. Terence, can you talk about the GameStop report and how clients are reacting to it?
Right. So GameStop is interesting and is probably got more public coverage than anything happened in the securities markets over the past year. It was very newsworthy, and as we all know, really suddenly and for really so far unexplained reasons, there was significant market interest in GameStop, including from people who were not regular market participants. You saw extraordinary trading volume and price movement over, as the staff laid out in its report, over a 3-week period in January 2021. The intraday trading price increased by 2,700%. So the staff report came out, as we all saw, and as Adam said earlier, identified sort of like dabbled in a number of different areas, including payment for order flow and off-market trading and other market structures, which led Commissioner Pierce and Commissioner Roisman to issue their own kind of quick response. I was going to say rebuke, but a quick response pointing out that there was nothing in the report that connected what happened in GameStop to any of those issues we identified, such as payment for order flow, which are very, as with everything in the markets and market structure, are very complex when you get down to looking at the details and thinking about adjustments to be made. As to clients, to answer your question, Sandra, really, as Adam said, it's all about disclosure is the most significant things. There are inherent conflicts between brokers and their clients all the time. All brokers are interested in their clients trading more, typically, than trading less. In the era of commissions, that is sort of obvious why they benefited from trading. And in an era where there may be payments from order flow or other advantages from increased trading, there's an inherent conflict at that level between the broker and its customers, Reg BI notwithstanding. So in terms from the client perspective, it just heightens again that there are all sorts of conflicts in the markets, and it all comes down to disclosure and what safeguards and processes clients can have to put themselves in the best position that if Adam Aderton comes knocking on their door complaining about some particular business practice, whether it's digital engagement or something else, that they have something that they can point to show why these risks or conflicts were reasonably disclosed to the customers.
GameStop is really interesting. I think some people on this panel, when we were preparing, said that their own children had made some money off of GameStop or one of the meme stocks. Maybe it was you.
Yeah, my son made money on GameStop off Robinhood. So he doesn't, in a year when the market went up 40%, it's easy to have all your trades come back winners, but
That's true. I think in the GameStop report, it said Robinhood's average customer age is 31 and has a median balance of $240, which perhaps shouldn't have surprised me, but did. It really, what we're seeing now is retail consumers have access to stock trading in a way that we've never seen before. And of course, the technology makes that happen. But to Adam's point earlier, what's so bad about broker-dealers having increased numbers of customers, right? I mean, we want to make access to the markets more democratic, and technology enables us to do that.
Yeah, I think you know what you can see in GameStop and a lot of these young people. It's a form of recreation. We're far away from Jay Clayton's concern about Mr. and Mrs. 401k. This is not retirement savings. This is sort of like, I can think of it like the daily fantasy sites where people can bet on, performance on football games. It's not that it doesn't require the same regulatory scrutiny, but in terms of the reaction we have to the game, the markets have, or the regulators have to the GameStop phenomenon, I think that kind of needs to be kept in perspective.
Jennifer, you sit on the Commission's Investment Advisory Committee. Is the Commission focused on the right things here? And what does all this mean for enforcement on Reg BI matters? We haven't seen those Reg BI cases really move through the enforcement pipeline yet or get to the end of the road on those investigations. What's your thinking on this?
Well, thank you, Sandra. So yes, I sit on, the Commission has a few advisory committees focused in different topical areas, and I'm a member of the SEC's Investor Advisory Committee. This committee is focused on protection of investors and trying to ensure the integrity of the financial markets. And over this last year, we have been very focused on the issues that all of you have been discussing right now: digitalization of the markets, certain equity market structure issues. We just in June 2021, so just this year, had market participants come in, as well as academic researchers, and talk about best execution. It's hard to talk about one issue in equity market structure without having to bring in a lot of other topics as well. So for the participants focusing on best execution, we also talked about payment for order flow, price improvement, and several other topics that I think we're going to get to a little bit later in our session here today. And then in this September, the committee had an interesting panel trying to understand, mainly from academic researchers, the psychology of how investors interact with these online platforms. I think this is a developing area for the committee. I expect there will probably be more panels focused on this in the future. The webcasts are available for the public to watch, so anybody can go to the SEC website and find those. I certainly agree with you, Sandra, that trying to make sure certain demographic groups who maybe have not invested as much as others in the past, that is an area that the committee is focused on and wants to sort of understand the dynamics there and how we can increase access to markets and engagement for all demographics. I think it's also important to understand, though, how investors are doing in general. It's another focus of the committee. So if we're looking at the digitalization, or we're looking at certain issues related to GameStop or the current equity market structure, what's the current status related to fees, performance, the likelihood that any of these interfaces cause investors to save more than they otherwise would if they did not have access to these features. I think these are all really interesting areas and where a lot of research is going on. Related to these topics, the IAC has not put forth any recommendations yet at this time. So the committee can provide recommendations to the SEC that are non-binding, but it allows us to have a dialogue and further engagement with the SEC. So perhaps that's something that could happen down the road once the committee finishes their engagement with the public on these topics.
Talk about some cases. Let's start with Robo Advisors. My Google search said there's over 100 Robo Advisors bringing automated and algo wealth management tools to retail and mid-market investors now. The commission, Adam, your group brought a case, SoFi, recently. Can you talk about that case and what it means? Is it consistent? Does it reflect your enforcement priorities here?
Yeah, so the SoFi case is interesting, and it's sort of a continuation of the first Robo Advisor cases that we brought in the division. We're back in 2018. There's a case called Hedgeable, a case called Wealthfront. Then we brought another smaller one over the summer, Emperor, and then SoFi in August. And I think what these cases show is that as robo advisors are taking a larger share of the market for investment advice, I think we should probably expect to continue to see cases involving robo advisors. And the charges that we've seen in these cases are sort of the typical charges that we might have seen in a non-robo case for the most part. So SoFi, the facts are a good illustration of that theme. In SoFi, clients in the robo product were invested in third-party ETFs. At some point, SoFi decided that they wanted to invest those clients in proprietary ETFs that were advised by, SoFi or SoFi affiliate. I can't remember if it was an affiliate. And there's a obvious conflict there when you're using proprietary products, and proprietary product cases aren't new. We bring those for years for the obvious conflict that's attendant, but seeing it in the robo context was new. There is one aspect of the SoFi case that I think even goes a little beyond that. And that is, in addition to noting the proprietary ETF conflict, the order also found that SoFi had represented that taxable account strategies would be optimized using generic tax assumptions, but then didn't consider the tax impact from the transactions on clients. And I think what's interesting there is that it shows a tension where a product like a robo product that treats most clients, or maybe all clients, the same, may struggle to deal with something like tax consequences. And so, those kinds of issues I could see continuing to crop up as robo advisors advise more assets, and as they sort of try to navigate how to discharge their duty of care going forward.
It's an interesting point about the robo-advisor's ability to understand their client, right? And what their needs are, or do they just treat every client equally? I hadn't thought about it that way before, but the technology is so sophisticated that certainly it's possible to get to know your customer in a more meaningful way there. There's another case in this area, Emperor Investments. Can you talk about the facts in that case, and in particular, the outcome there?
Sure. So Emperor, unlike SoFi, and Wealthfront that are sort of household name, Emperor was a very small advisor, robo-advisor in Toronto. But the facts there showed that that the advisor misrepresented past returns. For example, giving past returns for a number of years beyond the number of years that the robo-advisor had actually been in operation. They also made payments. The order found they made payments to bloggers for client referrals in violation of the cash solicitation rule that applied at the time, now sort of incorporated into the new marketing rule. And then that there were compliance failures. What's interesting about this case is that it kind of demonstrates the value of cooperation. If you go and look at the order in this case, you'll see that there is a fairly robust description of the cooperation that was afforded to the staff in resolving the case. And so, there are things like the production of voluntary narrative responses, factual summaries, other information that expedited the resolution of the case. And that is consistent with the kinds of things that we've heard from Gerbir and from others in the division about the types of cooperation that we'll take into account as we evaluate how to resolve a particular case.
On the last panel said at the beginning of every case, you should always think about the very end of the case and how you want to get there. And this case seems really instructive. Emperor, the resolution included only a C&D, a censure, and a $25,000 penalty. And I was really surprised by that when I read the facts, which are pretty bad in the commission's allegations. Terence, how do settlements like this inform your advice to clients as you begin a matter?
Yeah, and oftentimes when you begin a matter, you're sort of too far downstream to get the same kind of cooperation advantage, perhaps, that was present at Emperor, or for public companies in particular, always have active securities litigation, you're more limited on the kind of disclosures you can provide to the commission. As we know, various techniques are used, such as giving oral downloads, which The lawyers believe have some effect, but really have no legal bearing. And Judge Rakoff and others have certainly kind of seen through that over the years. So there's always that kind of conflict where if, which matter we're looking at, we're going to resolve with the commission, if that's the path the case is going in, buying down a civil penalty or a disgorgement figure, really a penalty, you're never going to buy down disgorgement, could have costs that are outside to what it could mean in other third-party litigation beyond just the enforcement action. So unfortunately, it seems that those kind of results, just from the outside, it seems maybe are more the exception to the rule. Certainly, we've all been involved in cases where clients have cooperated, and at the end, they're kind of smacking their forehead saying,
what was the point?
I thought this full cooperation was going to buy us something, and 10B and disgorgement that and penalties, and so that is it's definitely encouraging, and especially we have opportunities to deal with people like Adam, who we all know are very reasonable. But it's something that at least for me, we want to consider in broader context of other enforcement experiences as well.
Well, everybody just wants to hear from Adam on this panel. So Adam, can you talk a little bit about how you assess cooperation internally, and how do we prevent inconsistent results? Because, this case was defended or the company was represented by well-known counsel who was formerly very senior on the staff and is well-respected. And she got this great results, but other well-respected staff, defense lawyers haven't gotten this. So how do you prevent inconsistent results here?
Yeah, I don't know that I can help you prevent inconsistent results, but I can tell you is that I think every person who is in a position to be a senior officer or that level of decision maker, I think brings their own experiences to this. Grabir talked earlier today about empowering the staff. I think that probably means all of the staff, from the line investigator through the managers, through the senior officers. I think my perception is that he certainly respects the views of all of us in that chain. And I think the way to get to the best result is some of what we've heard today. Build that trust with the staff that you're working with. Get them comfortable with the work that you're doing, that they can trust you in terms of the information that you're bringing to them, that they can that the documents aren't being missed, that you're working cooperatively to make a complete production. Point them to the right things if you can, so that they understand what the important issues are and what you think the important defenses are. And I think if you do all of those things, I have a lot of faith in my colleagues all around the country. I think they all take a real service-driven and are always coming to it with the intention of getting it right. And they have the luxury here of that being their only mandate. So those would be my words of advice for how to get the best result in terms of ensuring consistency. Obviously, there's a really robust process at the commission that every recommendation goes through that to some great extent promotes consistency, but it's never going to be, no two cases are exactly the same, and you're probably never going to have totally consistent results.
So Terence, what do you think that means for cooperation for individuals in these cases? When you're representing individuals, they're not the first one in the door unless they're a whistleblower, right? And so how are you working to get cooperation credit for individual respondents in these matters when they're not the ones in the position to be responses or doing that sort of thing? That's on the company.
Right. So I would say there's two kinds of cases in the enforcement space, and immediately at the very beginning, usually, which of the two they are. One is the case that's going to settle, and the one is the case it's not. If you're representing a major financial institution, large public company, doesn't matter what the facts are. I've had these discussions with the most senior people at companies we all know, and they just view it as it's just part of the process. With an individual, your cooperation is very limited. as you know, if the individuals on the outside, typically they don't have access to much information from the company, if at all. If they're on the outside, they typically are going to be persona non grata. And if they're lucky, they would have gotten perhaps their email custodial domain. So you're much more limited. And frankly, I never had the feeling that the staff was looked to individuals as much as a source of cooperation or a party against whom there really would be much benefit. Now, some kind of multi-person fraud and people acting more like a true cooperator in the criminal context, maybe it's a little different. Individuals, we all represent individuals. It's different than representing a company, of course. It's deeply personal, of course, when people allege someone did something, and oftentimes the individuals have very strong feelings about the propriety of their own conduct. So I'd be interested to hear from you, Sandra, and Adam from the other side of the table, is what can individuals, what kind of benefit, what degree of cooperation credit can individuals usually get? If they're to the point of being investigated individually, it means someone else, typically people at the company or the lawyers for the company, have already been pointing fingers and helping make the case against them.
My experience representing individuals, that's often true. And it's hard to know what cooperation means. Certainly testifying, document production, doing everything that you can there, but that's consistent with our obligations. And frankly, it feels a little bit to me like no matter what an individual does in the asset management space, they're going to get a bar, no matter what. And there's no level of cooperation that will avoid that result. And that can be really frustrating. Some individuals want to litigate this, some are not able to for whatever reasons, mostly because they want to move on. So, Adam, any advice or thoughts that you can share on individual cooperation? Because, particularly in light of it will help us settle more cases and avoid litigation if we can figure out a way to get individuals some kind of credit.
So I think I'll tell you, we approach each case when we look at individuals in every case where we think it's appropriate. And when we think about individuals, we first assess obviously whether there's liability, the nature of the conduct, and then we'll move from that to the appropriate remedies. And remedies, especially the remedy of a bar, it may be that there is not much that can be done given the nature of the conduct that would allow us to recommend something other than a bar after the conduct has happened. Here you can think about something like, in some cases, misappropriation. There's a lot of things you can do after you misappropriate money that might help, but depending on the nature of the misappropriation and sort of the time frame and other things that went around it, there may be nothing you can do to avoid a bar in that circumstance. But I will say that there are other cases, sort of other categories of conduct where we will try to take a look at in every case, we'll look at the totality of the circumstances, but sometimes that might lead to a different remedy, even with respect to an individual. So maybe it's not a bar from association with an investment advisor. It's not sort of totally kicking somebody out of the industry. Instead, it's someone who was acting as a CCO and some other roles at the company. And we say, instead, you need to hire a new CC, you need to go out and hire a new CCO. So there's some kind of independent oversight or something like that. Or there may be an undertaking for a compliance consultant. Now that's going to be for the IA, but it's going to have an effect on the individuals who are working there. It's going to change the nature of the practices. And that might give us comfort that we don't need some of these other remedies with respect to that individual. Doesn't mean the individual in an ICC context where the advisor might not get charged, but it may mean they don't need a bar, or it may mean that we can get comfortable that they don't need to be suspended in this particular case, given the conduct and given the other remedies that we're getting. So in each case, we're looking at sort of the total package to protect investors going forward when we're thinking about things like bars, suspensions, compliance consultants, other undertakings.
And if I may ask a question, sorry, Sandra. So Adam, one issue is the bar. For financial professionals, we're all lawyers. We make our living in the law. If we were told, based upon some allegation of misconduct, we're being barred for the rest of our lives from being a member of any bar, it would kind of make it all or none. And in discussing with individuals, oftentimes you explain that the litigation itself will take 3 years just to get to the point of looking at potential remedies. It used to be the length of the bar was more negotiable than it is, it seems these days. And from the outside, it always seems that the tone of the commission is always to increase enforcement, to seek more remedies. Do you have, how much flexibility does the staff have today to negotiate something like a bar, the length of a bar, in a case involving fraud?
So I think you still see settlements that have time limited, or what we would call a qualified bar. An important point is that sort of all of our bars require you to reapply. Only suspensions do you get back in automatically. So whether it's a 3-year bar or a 5-year bar or a bar without a time limitation, all of those require reapplication to get back in and to reassociate. So I think it can be a factor, but I think from the staff's perspective, if conduct warrants a bar, our sort of, we'll look at it holistically, but in most instances, if the conduct warrants a bar, probably our starting point is going to be that bar needs to be without limitation. If we're in a position where we're going to recommend a bar, we think that the person against whom we're recommending should not be in the business of advising others, about their investments. And so I don't think you're likely to see a lot of the staff starting with the position that the bar should be shorter. I think they will probably hear your arguments, but I don't think you're going to see them start there very often.
Let's close out on these robo advisor cases. Jennifer, what do you think the big picture here is for the markets? Are you seeing a proliferation of traditional investment advisors stepping into the robo arena?
Yes, you have. And I think that effect is here to stay. So just some informative summary statistics. The assets under management in the robo-advising space are expected to triple between, if we look back at 2018 to 2023, rising up to about 1.5 trillion by 2023. Now, this, in terms of the firms that are providing services in this space, it still is fairly concentrated across a few entities. Vanguard has about 200 billion in assets under management. If you move down to number 3 or 4 on the list, someone say like Betterment, they're only at 27 billion. So you have a few entities that are more dominating the activity, but it is continuing to spread to other firms. And I think investors have really chosen to participate in this space. There's some research shows generational differences that are not surprising. Gen Z and millennials are much more confident and comfortable with using robo-advising, but you see activity really across all age groups. And in thinking about enforcement cases, I think it will be interesting in looking at the differential impact of robo-advising on investor types. So the academic research shows that robo-advising can lower some behavioral biases, but it can also, which is a positive, and it can also improve diversification, but largely for those who already came in the most under-diversified. So the effect of robo-advising may be more positive for some investor groups than others. And then, of course, you need to understand the fee structure and how that compares with alternatives. And I think also in thinking about enforcement, research has shown that there's a fairly high attrition rate of investors leaving robo-advising. But if you combine that with a hybrid approach of human and robo, that seems to retain investors longer. And then thinking about, should an enforcement matter rise, how you separate out the impact of the human versus the robo-advising, I think will be quite interesting.
Getting away from us, we only have 10 minutes left on our panel and a few things, amazingly, and we have a few more things to cover. So can we pause go back to payment for order flow just really quickly, Adam, if you could describe it so people know what we're talking about and what are the enforcement priorities here. And then if we can get to it, let's move to ESG for financial firms.
Sure. So payment for order flow is defined under Rule 10B 10D8 of the Exchange Act. And it's essentially payment to a broker for orders that are sent for the routing of customer orders. And so you can see how this could create a conflict for a broker in that they may prefer to route their customers' orders to whatever venue is the most remunerative for them. And perhaps that routing venue is not the best venue for those customer orders. And so what you can see is concerns about a broker's ability to discharge their best execution obligation when they are receiving payment for order flow. I think sort of the case that highlights these concerns is no surprise, I don't think, to anybody who's tuned into this conference, but there's the 2020 case involving Robinhood. These issues were front and center in that case.
Sorry, I was muted. That case was really a disclosure case, but this is one of the areas where I have heard, this should really be a market reg issue, and we shouldn't be in regulation by enforcement. What's your reaction there?
So I would say that this is an issue that the chair and others have talked about. I'm obviously not on the regulatory side, but the fact that they are discussing the issue and making public statements sort of describing how they view it suggests to me that some may have a view that this is an issue that should be addressed on the regulatory side. From the enforcement side, I think there can be issues here. I think you're right that a lot of the issues that came up in Robinhood came up through the disclosure context, and this calls back to what Terence was talking about sort of at the top. Disclosure is critical here, and obviously enforcement is likely to come on the scene if practices that involve conflicts are poorly disclosed or not disclosed at all.
What about ESG? ESG we've heard about on many panels a bit today, and we hear it in the news all the time. It's a significant issue for financial firms in addition to public companies for slightly different reasons. And in September, Chairman Gensler asked the staff to review fund disclosures and consider whether asset managers should disclose additional ESG criteria and data to investors. There have not, however, been a lot of enforcement cases yet in the ESG world. There was a case in 2008 involving a settlement with a company called Pax World concerning those issues. Adam, can you talk about that case? I think it's probably illustrative of the kinds of things we'll see coming down the pike.
Yeah, so Pax World is a 2008 case, and but for the ESG angle to it, I don't know that any of us would be talking about it today. But the ESG angle is, I think, a really good example of how a case like this could arise. So Pax World was advised a sustainable investing fund. They said that there were particular industries, arms manufacturers, things like that they weren't going to invest in. And then, over time, they did. And so I don't think anyone should be surprised that when an advisor says that an investment product is going to invest in particular things or not invest in particular things, and then it does, that enforcement shows up and may bring an enforcement action in those circumstances. And so I think in the fund context, that is the kind of case that you could see repeated. It's especially with the sort of massive proliferation of ESG strategies and the volume of assets that are moving to ESG strategies. It's not a given that this kind of situation will happen again, but the likelihood seems to increase as the assets move that way.
Earlier today, the greenification, which is my new favorite phrase on this. Jennifer, can you talk about the role DERA is going to play in helping assess these ESG and greenification issues? Do you expect DERA to be working closely with enforcement here?
Yes, I do. And DERA already works closely with enforcement when it comes to enforcement against funds. DERA can be very helpful in terms of providing quantitative assistance. I think that in thinking through how this may impact funds and the choices that they make and how they market their ESG to investors, that's got to be tied up with the underlying issuers. And so you really need to understand how are the underlying issuers identifying and defining the E, the S, and the G. So if you want to measure companies' performance and their achievement of those ESG goals, you have to know exactly how they've been defined in order to be able to measure things like performance to that goal, and whether the performance actually correlates at all with that goal. So I think DERA traditionally has been involved in helping assist on enforcement cases against funds. I expect that to continue even in this space. But then also, should the SEC move forward with rulemaking in this space, I expect DERA to be heavily involved, as they would for any rulemaking.
Terence, how are you advising clients on these ESG issues on the asset management side?
Right. So this is one of the most probably dynamic areas of the securities laws, and I get more calls related to ESG type issues than anything else. As Adam said, there's a tremendous amount of capital being allocated into the ESG space, and such to the point where asset managers can't even find some place to deploy oftentimes the capital they have. Now, the common thread through our presentation has been disclosure, and if there's a conflict, if you disclose it, and typically disclosure can be the cure to problems, and the securities laws, of course, are disclosure based. But the real challenge here is that no one can really agree what the ES, the E and the S and the G stand for, and it's so subjective as to whether something properly qualifies for ESG characterization or not. Commissioner Roisman, as we saw in his response to the proposed proxy amendments, pointed out the ambiguity of many of these terms, and that really leads to potential problems later. I mean, one real-world example is I have a client that's a mining company, and they mine materials that go into electric vehicle batteries. Now, are they an ESG qualifying company? Ordinarily, you think mining is not, but and this company, by the way, has never had SEC or regulatory problems. But as the chairman of the company says, every time he sees a Tesla going down the road, all he sees is 600 pounds of graphite. And without the graphite, you don't have the Tesla. So that's just one example of something that in some ways could seem ESG qualifying and other ways very much not. So to the extent you advise clients, we have to give real thought to how they clearly define what their investment strategy is for if it's an investment manager. And then from a lot of the discussion from the commission, you have an ongoing obligation now increasingly. I won't say OC, but I'm trying to learn that, the cool kids now, it's all the division of examinations, but they gave the risk alert when identifying things they'd be looking at. And, they seem to be not just encouraging, but requiring asset managers to, on an ongoing basis, continue to monitor whether the assets they've invested in still qualify for ESG treatment. So it's a challenging area, and I think we'll be hearing a lot more. The last thing is we saw Deutsche Bank announced in, I think it was August, that there is a joint investigation, with all respect to Commissioner Gebier, or the Director of Enforcement. They're being investigated by DOJ and the SEC regarding their claims regarding sustainability investing and ESG type investing. So there could be another enforcement action coming down the road.
Yeah, you're right. It's very confusing. I'm not sure what the E, the S, and the G are. All I can say to clients at this point is, say what you do and do what you say until we get some further guidance. Adam, are you finding that sort of lack of clarity around what these initials stand for is affecting enforcement matters?
I think I think when you see enforcement matters, especially in newer areas, it's usually not the close cases. And so I think you are more likely probably to see early cases where someone either didn't say what they do or didn't do what they say, as opposed to cases where there might require a more nuanced judgment about whether a particular investment hits the E, the S, or the G. I guess remains to be seen, but that's sort of my initial take on the likelihood of where the likely cases might be here.
Thank you. Bruce has appeared, which means it's our time to go. Thank you, everyone. It's been a great panel.
Thanks, Sandra. Terrific job moderating. And Terence, Adam, Jennifer, thank you so much for joining us and sharing your expertise, and particularly Adam for joining us from the SEC. We really do appreciate it. The next panel is quite interesting. It's a whistleblower update with a lot of the current and former leadership of the office of the whistleblower at the SEC. So it should be really interesting. It'll be at 4:55. We'll see you back here in 5 minutes. Thank you.